Corporate finance practice problem using Excel. Convertible bond and diluted earnings per share. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side, calculating our earnings per share and then the diluted earnings per share, given the fact that we have convertible bonds outstanding, those being bonds that provide the investor the option but not the obligation to convert them to some shares of common stock. If they chose to convert them, we'd have more shares of common stock out there, resulting in a different and lower earnings per share, which we're going to call the diluted earnings per share. So when we're thinking, of course, this complicates things a lot because we don't know exactly what could happen. So we want to calculate the two ends of what could happen, in essence, the earnings per share, as if there was no exercise, and then what could basically happen on an earnings per share basis if there was an exercising of the convertible bonds to have more shares that would be then outstanding. So we have then the net income is at the 800,000. The shares outstanding are the 70,000 shares we're saying are outstanding. The convertible bonds, there's $1,600,000 amount of convertible bonds. The par value is 1,000, rate at the 12%. The conversion ratio is 25. So in other words, the one bond can be converted into 25 shares, and the tax bracket is going to be 35. So if we take it at this point in time and we say, okay, this is the net income, and with no conversion taking place, we can just say earnings per share calculation straightforward is simply going to be the 800,000 divided by the number of shares, which we said was 70,000 shares outstanding. Net income, of course, being the performance number, bottom line of the income statement, font group, underline. That's going to give us our normal kind of earnings per share calculation, which would simply be the 800,000 divided by the 70,000. Let's add a couple pennies, though, by going to the number group, adding a couple pennies, adding a few decimals. So now let's take a look at the diluted earnings per share, which we're going to assume then that all these shares are then converted. So we can think about what would happen if basically there were a maximum number of shares that could be out there, given the fact that this option is out there. Well, we could say then that the net income started at the 800,000, and then we're going to make an adjustment for it for the interest that would be involved. So if there was a conversion, in other words, then we wouldn't have the interest and the tax impact related to it in the net income number. So we'd have to basically pull that out. So we're going to call this the interest on bonds, basically, and take into account the tax impact as well. So we're going to take the convertible bonds. I'll just pull up the name over here with the amount of the 1,600,000. There's a rate that we're going to be paying. That means we're going to be paying interest on them. We're going to assume yearly interest payments at the 12%, making that a percent number group, percentifying it, and then we're going to go to the font group and underline. That would mean that we'd have interest on the bonds that we would have to pay, and that would be equal to the 1,600,000 times the 12%, or 192,000. But then that interest that we're paying also has a tax impact on it, which is actually a benefit for us because we would get the expense of the interest, and then the tax would then be a deduction. So we kind of get back, in essence, the tax at basically our highest tax bracket, assuming this is done basically at the margin or the last thing, noting that we have a progressive tax system and so on. So we're going to pick up our last tax bracket, which is going to be the 35%. Or let's pick it up this way. We're just going to do it 1 minus the tax bracket. So that way we're kind of taking into consideration the tax impact of it and in one swoop. So we're going to say this is going to be 1 minus the tax rate of 35%, meaning the net impact is going to be 100% minus the 35%, or number group, percentifying the 65%. Font group and underline, that's going to be basically our interest added back. Interest added back after tax impact, and that's going to be the 192 times the 65%. And maybe I should put that up here too. The interest on bonds after taxes. And so there we have that. And then that's going to give us our adjusted income, which we're going to be adding back. We're going to say the 800,000 and the 124.8 is going to be our adjusted net income at the 924.8. So font group underline. So we've reversed kind of the tax impact. Let's make some formatting things here. We're going to select these cells, alignment group, and indent them, and then I'll indent this one more time, alignment group, and indent it again. So now that we have the adjusted income, reducing or removing the impact of the interest that would be paid, and that would be a deduction, lowering the amount, and then the tax impact related to it to get to our adjusted income. We can then calculate our adjusted number of shares that are going to be impacted, assuming that the bonds, if the bonds had been exercised. So we'd say, okay, well, the beginning shares would then be the 70,000. That's where we started off. And then we have the conversion. So if there was a let's say converted shares, or the atted shares, the shares upon conversion, would be the convertible bonds. Let's call it convertible bonds. We have convertible bonds. Now, they didn't give us the amount of convertible bonds, but we know that there's a par value of the 1,000, and we know the amount of total bonds is 1,600, so we can divide those two out to get the number of bonds that are out there, which is going to be 1,600,000 divided by 1,000. That would mean that there's 1,600 bonds out there, and they can be converted given the conversion ratio to 25 shares of stock. So that 1,600 could each be converted, those are all the bonds, to 25 shares each of stock, resulting in, font group underlining, the converted or new shares, the converted new shares, let's call them, of the 1,600 times the 25, and that would give us 40,000 new shares that would be out there. So I'm going to go ahead and indent this by going to the alignment, indent. We'll indent this one to alignment, indent again. That means that the ending shares, or they call it the adjusted number of shares, is now going to be the original 70,000 we had plus the 40,000, assuming they were all converted. We'll go to the font group and underline. So then we can calculate the diluted earnings per share now that we have our net income, which is the adjusted. Let's pick it up from up above. We'll just say this equals. That's easier. Less likely for me to misspell something that way, or unless I misspelled it up top, and then I'll do whatever. You know what I'm talking about. So we're going to take that one. Then we got the adjusted number of shares, which would be the 110. And let's underline that by going to the font group and underline, and that'll give us our diluted earnings per share, which would then be the 924.8 divided by the 110,000, adding a couple decimals, number group, couple decimals. Now, of course, the diluted earnings per share is diluted, meaning it's lower than the earnings per share before, because, of course, if there's more shares out there, then it'll typically result in less of the net income, even though we do have that income impact, given the fact that if they weren't converted, then there would be basically amounts that would be paid out in terms of interest, and there'd be a tax impact basically on the interest as well. So note, these are kind of like the two ends that you would take place, right? We're saying here this is before with no conversion that took place, and the diluted earnings per share is kind of like, well, that's the other side of the spectrum. We're going to assume that all the shares were converted. Obviously, then anywhere in the middle, you could have some portion, of the shares. You could get more complex and say, well, how many shares do you think are going to be converted? If you would think some portion of the shares would be converted rather than all of them, you can run different scenarios, what if scenarios and whatnot in those kind of situations.